Good day, everyone. My name is Karen Campo Amor, and I'm going to report the topic 10, the importance of cash flows. What is cash flows? Cash flow is the amount of cash that comes in and goes out of a company. Businesses take in money from sale as revenues and spend money on expenses. They may also receive income from interest, investment, royalties, and licensing agreements, and sell product on credits, expecting to actually receive the cash owed at a late date. Why cash flow is important? Cash flow is defined as the amount of money entering and leaving your business over a given period of time. Cash flow is important because it enables you to meet your existing financial obligations as well as plan for the future. There are three critical parts of companies' financial statements. First, the balance sheet, which give one-time snapshots of companies' assets and liabilities. Next, the income statements, which indicates the business profitability during a certain period. Next, the cash flow statements, which act as a corporate checkbook that reconcile the other two statements. It records the company's cash transactions, the inflow and the outflows during the given period. It shows whether all the revenues booked on the income statement has been collected. Types of cash flows. First, cash flow from operation stands for CFO. Next, cash flow from investing stands for CFI. And the third is cash flow from financing stands for CFF. Cash flow from operation Cash flow from operations stands for CFO, or operating cash flow describes money flows involves directly with the production and sale of goods from ordinary operation. CFO indicates whether or not a company has enough funds coming in to pay its bills or operating expenses. In other words, there must be more operating cash inflows than cash outflows for a company to be financially viable in the long term. Cash flow from investing CFI. Cash flow from investing CFI, or investing cash flows, reports how much cash has been generated or spent from various investment related activities in a specific period. Investing activities include purchases of speculative assets, investment in securities, or the sales of securities or assets. Next is cash flow from financing, stands for CFF, shows that net flows of cash flow are used to fund the company and its capital. Financing activities includes transactions involving issuing debt, equity, and paying dividends. Cash flow from financing activities provide investors which insight into a company's financial strength and how well a company's capital structure is managed. Next, the cash flow and versus profits. Contrary to what you may think, cash flow isn't the same as profit. It is it isn't uncommon to have these two terms confused because they seem very similar. Remember that cash flow is the money that goes and out of a business. Profit, on the other hand, is specifically used to measure a company financial success or how much money it makes overall. This is the amount of money that is left after a company pays off all its obligation. Profit is whatever is left after subtracting a company's expenses from its revenues. There are three categories of cash flows. First, operating cash flows. Next, cash flow from investments. And lastly, cash flow from financing. Operating cash flow generated from the normal operations of a business, including money taken in from sales and money spent, and the cost of goods sold, stands for COGS, along with other operation expenses such as overhead and salaries. Cash flow from investments includes money spent or pursuing securities to be held as investments such as stock or bonds in other companies, or it is or in treasurers. Inflows are generated by interest and dividends paid on these holdings. Cash flow from financing. The cash flow of raising capital such as shares or bonds that company issues or mini loans it takes out. The bottom line. Cash flow refers to money that goes in out. Having a positive cash flow means this more money coming in, while a negative cash flow indicates a higher degree of spending. The latter isn't necessarily a bad thing because it means that you're investing your money is growth. But if your spending becomes excessive, you won't have enough for a rainy day, and you won't be able to pay your suppliers or lenders. Whether you're running a business or household, it's important to keep on top of your cash flows. Explain the relationship between cash flows and accounting flows and the magnitude of cash flows. All three accounting statements are important for understanding and analyzing a company's performance from multiple angles. The income statements provide deep insight into the core operating activities that generate earnings for the firm. The accounting flows and magnitude of cash flows, however, focus more on the capital management of the firm in terms of both assets and structures. Overall, top performing companies will achieve high marks in operating efficiency, assets management, and capital structuring. Management is responsible for overseeing these three levers in a way that serves the best interest of the shareholder, and interconnected reporting of these levers is what makes financial statements reporting so important. And that's all. Thank you for listening my report. God bless you all.